The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Hello and welcome to Squawk Box Europe. I'm Karen Cho with Juliana Tattelbaum, and these are your headlines. French and German stocks kick the week off in the green after Trump's tariff delay boosts sentiment, with autos and aerospace leading gains.
A global euro moment. ECB President Christine Lagarde says the single currency can rival the greenback amid geopolitical volatility if the bloc can bolster its security in capital markets.
Moments of change can also be moments of opportunity. The ongoing changes create the opening for a global euro moment.
And Tesla posts another month of massive sales declines in Europe, down more than 50% on the year, while petrol car sales slump by more than a fifth.
The European and US trade position undoubtedly the top story this morning, but we're still waiting on further progress. And we had just a glimmer of hope that markets were confident yesterday that there could be progress, conversations in terms of, again, what Šefčovič is doing in the backdrop, trying to ensure that there is progress. But I think what we're left with under the surface is frustration by business. I saw some reports that, look, businesses simply just cannot plan around some of these transatlantic ties, but they're frustrated that they've been built up over many, many years, and here they are upended by a couple of tweets and posts and the position by the President of the United States.
You know, I think when it comes to Europe, if there was ever a time for Europe to shine, now is it. And the question is, will European authorities, policymakers be able to seize the opportunity? We've heard from Christine Lagarde in the last 24 hours saying this is an opportunity for the euro to shine through as a reserve currency. And I think that's the question Europeans are asking on all fronts. We've got fiscal spending coming, we've got relative political stability, and we've got turmoil in Washington by a number of measures. So can Europe step up to the plate and take this opportunity here?
Well, I asked this question to Sylvia yesterday when the news flow was breaking, because I did have that inkling. We'd had a lot of momentum, and it felt like some of the momentum had just started to wane a little bit after very aggressive fiscal packages. So I do wonder whether, again, this is a fresh reminder that Europe does need to get its house in order. The latest is that the European Commission says it will fast-track trade talks with the US a day after President Donald Trump agreed to postpone his threatened 50% tariff on all EU goods until the 9th of July. Meanwhile, the EU's Trade Commissioner Maros Šefčovič held talks with US Commerce Secretary Howard Lutnick and Trade Representative Jameson Greer on Monday, posting on X afterwards that the EU is committed to reaching a deal and remains in constant contact with Washington. Christine Lagarde says the euro is facing a global moment that could boost its role to rival the US dollar. Speaking in Berlin, the ECB president said the euro can offer geopolitical stability that the US no longer guarantees. But she stressed that does depend on Europe strengthening its capital markets as well as its defense and security.
For the euro to increase its global status, history tells us that we need to build on three foundations, each of which critical to its success. First foundation, Europe must ensure that it has a solid and credible geopolitical foundation by maintaining steadfast commitment to open trade and underpinning it with security capabilities. Second foundation, Europe must reinforce its economic foundation to make it a top destination for global capital, enabled by deeper and more liquid capital markets. Third foundation, we must bolster our legal foundation by defending the rule of law and by uniting politically so that we can resist external pressure.
Well, yesterday, UK markets were closed, which meant lower liquidity than usual for European markets. But the ones that were open did see investors put money to work after the reprieve from President Trump over the weekend, after that call with von der Leyen saying that he would postpone the potential implementation of 50% tariffs on the EU until July 9th from June 1st. So all the major regions that were open for trade yesterday closed higher. You've got the Xetra DAX closing about 1.7% higher on yesterday's trade. The CAC 40 over in France ended 1.2% higher. We also had more than 1% worth of gains for the Italian market. Now, looking under the surface and what we saw from a sector perspective yesterday, the auto sector saw some decent trade yesterday. A number of the stocks closing more than 2% higher. You actually had Stellantis, which is right at the heart of trade tensions here, given the complexity of its supply chain. That stock gained about 5% in yesterday's trade. We also saw a strong bid for European industrials. Here's a look at some of the key movers. You've got Thales gaining about 2% in yesterday's trade. Rheinmetall in the defense space gaining more than 3%. Siemens had a strong day as well. I think the real test is going to be what happens today and in the days to come, given that investors are back in it after the holiday yesterday.
Well, let's take a look at those Asian markets. Don't forget, lacking again those US leads that we typically get from Wall Street, and those Asian markets somewhat mixed as a result. We've got Japanese, Hong Kong stocks bouncing modest territory to the upside versus a pullback for the Shanghai Composite and the Kospi. Industrial profits are closely watched out of the Chinese market today. What we're seeing from the European futures today as we get set up for the trading session, we are rolling off the back of a decent bounce. It looks as though the FTSE reopening after bank holiday, looking to play catch up to the rest of the European boards versus a mixed picture expected on French, German and Italian names. A little bit of green, a little bit of red on those boards. Well, US futures after Memorial Day, as we also look for those US markets to open up again, looking for some positive territory. And don't forget, we've had all the news flow around the US and European trade tariffs. Now with the pause period being enacted, seen as a positive catalyst, and you can see markets set to respond later on today. Some of the safe havens, as we also look at the defensive characteristics still of this market, and you can see gold tracking a little bit lower morning session, 1.25% down. Treasury yields also 4.46, so just pulling back a fraction. And gold prices have been surging amid global uncertainty, but our next guest says higher prices have been dampening demand in areas like jewellery and central bank buying. Meanwhile, more recently, a rebound in stocks is beginning to pull investors away from gold into other assets. Amy Gower is metals and mining commodities strategist at Morgan Stanley. Thank you very much for joining us. Looking into your report card this morning about where the sector's at, fascinating you use the word stabilised for gold because it's been such a red hot area for a lot of buying of late. Central bank buying, Chinese buying, broader defensive appeal. What's changing now around some of those characteristics?
Yeah, I think we need to remember the gold price moves have been very, very fast. So, it took us about 6 months to make a $500 move up to the 3,000 level. We then got to 3,500 in about 10 business days. So I think it's fair to say you would expect some stabilization. I think in terms of what's changed, the big new money that's come into gold this year has been the ETF buying, their exchange traded funds. They've been largely absent for about 4 years. So they came back in and really rapidly, with that uncertainty, scaled up purchases. And as equity markets have rebounded, as we've seen a bit more risk on, some of that money has been coming out. So high frequency data suggests they've sold about a quarter of what they had bought year to date. And I think that's going to be the key kind of push and pull on the gold market.
That old saying, what goes up must come down. I've been nervous around the gold trade because of that speed, and we saw a lot of the analysts really just changing their forecasts on the hoof as we hit some of the early markers at the start of the year versus their end of year forecasts. If there was to be one reason for the market to come crashing back very aggressively, what would it be?
I think it's really about where that incremental money is coming from. So I think if you start to see those ETFs no longer buying, but then also we're already seeing slowdowns in other areas, I think that could be quite a challenge for gold. Potentially also if the dollar started to change direction and go back up again, that could be difficult. But I think really it's going to be that if jewelry, central banks, bar and coin and ETFs all start pulling back at the same time, that's probably going to be quite difficult for gold to maintain.
Amy, let me pick your brain about the central bank piece here. Looking at the data, Chinese and the Chinese and Indian central banks have ramped up their holdings of gold, but still, as a percentage of their overall reserves, still well below what we've seen from other Western central banks. What scope is there for China and India to ramp up their gold holdings? You say that they haven't actually been a big piece of the puzzle, to Karen's question.
Yeah, so they've been big contributors to the sort of step change we've had in central bank buying since 2022. But as you mentioned, a lot of central banks still have very low holdings. I think India is now slightly above 10%, China's still below. And we worked out even if every central bank was just to go to at least 10% of holdings, and that compares to some of the Western central banks up at 60, 70, 80%. So just 10 on a global basis. That would sustain 4 more years of buying at the current pace. If it was to go to 20%, then even more, probably up to sort of 8, 9, 10 years, depending on pricing. So plenty more scope for that pace to continue. But I guess the key thing is the pace has steadied. It's not increasing every year. They're buying about the same amount year after year.
How sensitive are they to the price of gold? Is that, to what extent does that factor into the sort of steady pace, the reason we haven't seen them ramping up more recently?
So I think it's both the price of gold and the pace of the move. So we did see China pause for about 5 months last year, and that was after we'd had quite a rapid ascent in gold prices, and then they stepped back in November, which was actually where we saw prices stabilize. They have stepped back in at a lower rate to what they were doing in 2023, early 2024, but they are still buying. For India, it's more of a total India import number. Again, you can sort of see as the prices come up, that pace has slowed, but they are very much buying.
Can I switch to copper? And at the risk of bringing up another golden oldie, the Dr. Copper trade, it used to be a thing. We'd look for the macroeconomic impact on what copper demand was looking like. In recent years, we've been told Dr. Copper is now Dr. Green, thanks to all the clean initiatives that really bolster the demand for copper. What is taking place here? Because we're getting really mixed data on the EV side at any given moment. Why is copper coming off so aggressively? Is it just the macro, or is it the renewable side too?
So I think, copper is facing, I guess, its own supply-demand fundamentals and then these longer-term thematic stories. And I think the thing with industrial commodities is they're not very good at pricing in the future. They can really only tell you what's happening right here, right now. So if the green story is looking great on a 5-year view, but today nobody wants to pay that much for copper, then the price is only going to reflect those current fundamentals. I'd say actually right here, right now, the copper fundamentals look quite good. So we're seeing quite strong physical demand. If we look at things like China's grid spend, it's up around 15% year to date. That's one of your key end-use sectors for copper. And also we've had this pull forward of demand into the US. So President Trump has put a Section 232 investigation on potentially putting copper tariffs in place. And what this has done is pulled forward demand of copper into the US, which is currently tariff-free. So we think probably that's been about 1% of global demand has been extra US demand in the last three, 4 months of the year.
While we've got you, can I ask you about lithium? China has currently got a hold on lithium supply. Could that change anytime soon?
I think that the challenge with lithium is it's a very widespread resource, and lots of countries want to develop it. So, going on that thematic note, lithium has this bright future in terms of the EV demand, the stationary battery storage, which is going to be key as we build out renewables. And so it's sort of viewed as a critical mineral, and it is quite abundant. So China has been developing a lot of lithium, partly because prices were able to get to such high levels a few years ago. But other countries are also growing supply. So we've got new supply coming in Brazil, for example, at the moment, and still growth in your more traditional sources. So I think wouldn't see China's growth dominance changing anytime soon, but plenty of scope for other areas to ramp up as well.
I was looking at a report from Zijing Mining. It's obviously been manoeuvring around some of its asset prices and spin-offs, and whether to just focus on gold versus some of the other commodities. But there was some devil in the detail, which was that, look, some of the big multinationals are just less willing to sell assets at this point, particularly as you see that Chinese demand around critical minerals and everybody else now having the same psychology. What are you seeing in terms of the pricing of assets and the movement of those assets right now, thanks to the geopolitics?
I think it's, I guess it's always tricky when you're not sure what the key metals are going to be as the future evolves. We always have risk of substitution, we have uncertain demand paths, we have, as you say, the global economic backdrop as well. So I think that does make it quite tricky. We are probably seeing more exchange of assets in some areas. So in gold, for example, we are seeing a bit more, but maybe not in those areas where everyone wants to hold on and hope for that future. And that's the thing, commodity prices can still, even if we know the future story, they might not be pricing it in yet today.
We've come a long way from balance sheet rationalisation, haven't we? Which was the last big trend. Amy, thank you very much for joining us. Amy Gao with us, metals and mining commodity strategist at Morgan Stanley. Greenland says it will turn to China if US and European mining companies do not invest in the territory. Greenland's Minister for Business and Mineral Resources told the Financial Times the territory is looking to develop its business sector and diversify it, adding it wants to work with European and American partners first. Greenland, which is part of Denmark but autonomous, is home to large deposits of critical minerals, including gold and copper, and has recently become a subject of dispute between the Trump administration and the Danish government.
Coming up on the show, industrial profits in China rise for the second straight month. We'll discuss the full story next. Plus, European insurers are facing heavy losses after the LA wildfires earlier this year. Our very own Ganesh Rao will join us with more later this hour. And a few weeks into Merz's premiership, we'll get a check on the German economy. Don't miss our conversation with the chair of the German Council of Economic Experts at 8:15 London time.
China's industrial profits rose for a second consecutive month in April, climbing 3% compared to the same period last year and 2.6% from March. This despite the Trump administration imposing tariffs of 145% at the beginning of the month before pausing more levies following trade negotiations in Geneva. Moodys has reaffirmed its negative outlook for China, blaming ongoing trade tensions with the United States and other Western countries. In a note, the ratings agency said it no longer considers local government debt and insolvency risks as the key issues facing the world's second largest economy. Instead, it is warning of worsening trade restrictions, adding it expects tariffs on Chinese exports to remain elevated throughout the year. That is quite telling, isn't it, given how much concern there was around the real estate sector. Let's just take a quick look at what we're seeing on the Asian markets. And so far, we've still got green on the Japanese stock market. Hong Kong stocks up by about 0.5%. China itself peeling back 0.2, and we've got a little bit of a pop for the Australian market today. Let's get to Sean Ryan, who is founder and managing director at China Market Research Group. Sean, thank you so much for joining us. Let me just pick up on that remark from the ratings agency about some of the chief concerns really stemming from exterior threats now, some of the tariffs that have been imposed, what that means for the geopolitics, but also the credit conditions back at home. That is remarkable given we've all been so laser focused on the property market for so long. What do you make of it?
Well, it's great to be here, Karen. So I actually disagree with Moodys. No surprise here. I think local government debt, an aging population, and a weak real estate market still are the three key areas that I'm most concerned with. I'm not overly worried about the tariff war and the trade war. I think, I don't want to say Chinese are exuberant right now, but they are happy because they feel that China has the upper hand in the trade war with Trump. I mean, basically everything that America sells, except for semiconductors and ethane, China can buy elsewhere. So instead of buying American beef, they're buying Australian beef. Instead of buying American oil, they're buying Canadian oil. Instead of buying American soybeans, they're buying Brazilian soybeans. So the Chinese consumer over the last 2 months has increased their happiness and optimism, highest since I've seen in the last 6-7 years. So I'm more bullish on China's economy now than any time since 2019. And you see that reflected in retail sales. They went up 5.1%. Tourism went up 8.1% during the Qingming Festival. So the biggest issue is not the trade war. China's winning. China's not going to back down. Everybody in the world knows that, except for Trump and Scotty Besson, apparently. The biggest issue still remains local government debt, an aging population, and weak real estate prices, Karen.
Sean, that feel-good factor that you demonstrate also in the industrial profits numbers for April as well. We saw that picking up some pace. But just what are the self-help measures going to be from here? Because it feels as though some of it has been designed to put a prop under the domestic economy. You're saying you can see that firsthand. But at what point do we conquer some of those long-running issues that we talk about around local government debt? Because to me, it feels as though that could get much worse if we're going to see further self-help domestically.
Yeah, it's going to take several years to fix local government debt in the real estate sector. And I think, Karen, that the government doesn't really want to fix real estate. Prices have dropped 20 to 30%. I think the Chinese government wants this to be a soft landing. But there's some key numbers. First of all, overall, in third, fourth, fifth tier cities, prices only dropped 4% year over year last month. That's better than the 5 to 8% from last year. And in Shanghai, prices in the 180,000 RMB range, or about 25,000 US per square meter, are actually soaring. So you're seeing a rebound in tier one cities like Shanghai and Shenzhen, and you're seeing some sort of a stabilization in third through fifth tier cities. I don't think the Chinese government wants to reinflate the bubble. They're okay with sort of a stabilization and slow movement. I do like some commodities though. Right now, chrome ore, which is one of the keys for chromium, which goes into stainless steel, which goes into construction, is actually booming right now. And Chinese buyers are buying it up very quickly. So you're starting to see a movement. But especially, I think what's important, Karen, is on the unemployment side, it's actually getting better. You're not seeing the mass layoffs. You're not seeing the mass cuts in salary that you saw at the end of 2024. And that's why I think over the next 6 to 9 months, you're going to see a recovery in consumer spending. Don't forget, Chinese households are sitting on 20 trillion of household savings. So they will buy when they see value. They're holding on to their pockets. So instead of Starbucks, they're buying Luckin. But if they see something good, such as Hoka or On in sports apparel or Lululemon, they'll buy that. But they'll skip Nike because it's seen as overpriced and not really cool. The consumer rebound, green shoots, but it's starting to happen. It's not booming, don't get me wrong, but this is the best China's economy's been in the last 6 years.
Sean, what about the luxury consumer in China specifically? I think investors here, investors in European luxury companies, are finding it hard to predict what comes next for the Chinese luxury consumer. So what are you hearing? What are your channel checks telling you?
I'd be very cautious. We're doing a lot of channel checks with luxury. I'd be very cautious on brands like Gucci and Burberry. They've made some good advertising moves in the last 4 weeks, so you might see a slight bump up. But overall, Chinese consumers are still anxious, and they just don't see value in brands like Gucci and in Burberry. But we do like Hermes, and we do like Chanel. They will be the long-term strength because, again, the top 0.1% are spending more in luxury, and they're spending on real estate. I think the highest end is okay. But I still would stay clear of luxury, and I would go more for aspirational premium buys, like the On and Lululemon, like I just mentioned, maybe in East Rock and Luckin and some of the food players. I'd be cautious on luxury right now. We still aren't seeing a complete turnaround in consumer confidence.
Sean, I asked a China analyst a few months back if we were seeing any signs of boycotting of American brands, a backlash against the what's happening in terms of the Trump administration's actions. And they said at that point, President Xi hadn't turned on the so-called propaganda machine, and that at that stage, when he did, that's when we would start to see a boycotting of American goods. Are you seeing that now? And would you consider that so-called propaganda machine turned on, as many would call it?
So a lot of hedge funds have asked us this, and we've actually been doing a lot of channel checks around the country the last 2 months since Liberation Day. We've seen absolutely zero hint of boycotts against American companies, and we're not seeing the Chinese government fueling any propaganda, because even though I'm more bullish now than any time in the last 6 years, we have to be honest, the economy is still weak here. We're seeing hundreds of thousands of people are losing their jobs in Panyu and Guangdong province because of the tariff war. These are companies or factories that make 50 to 100,000 US a year in revenue. They're not able to export to the United States right now, so they're closing. So China's government is taking a very pragmatic mode. They want to continue to attract American investment. So they're not putting on the propaganda wars to attack American companies. The reality is Chinese are saying, why spend 35 30 RMB for Starbucks coffee when they can buy a coffee from 9.9 Kwai. It's not because they're angry at Starbucks. It's not because they're angry at America. It's just not good value. And the Chinese are basically outcompeting the American companies right now. No hint of boycotts, frankly.
It's pragmatic, isn't it? Pragmatic behaviour by the Chinese consumer to save money where they can. I want to ask you about EVs, Sean, because we've seen reports in recent days about big discounting by the likes of BYD, that perhaps they'd over-egged it when it came to too much inventory and now try to just clear that glut. What are you seeing in terms of those bigger ticket items in the Chinese market?
So people are still buying EVs. About 55% of new car sales in China have been NEVs. Very bullish on the sector, but there is a lot of maybe overcapacity. There's been too much production. And then more importantly than that is the competition's fierce. Everybody is cutting. Consumers are waiting for the next discount. And that's why you see BYD is discounting up to 20% is the rumor, because they're trying to clear out old inventory and be able to compete against, Huawei, compete against Xiaomi. I'm very bullish on the NEV sector as a whole, but I don't like too many of the brands. I would prefer you buy CATL or CATL, a battery maker, or BYD, because those batteries are going to go into all of the NEV companies. What we found, Karen, is there's almost no brand loyalty for Chinese consumers to a specific NEV brand. They're just going to buy whatever is a good deal at the moment. It's not like a Porsche buyer who will, once he buys a Porsche, he or she will never buy another brand except for Porsche for an entire life. For Chinese NEVs, they'll buy BYD one year, Xiaomi the next year, Xpeng the next year. So buy the batteries, buy the commodities, underlying like a lithium. Don't buy the actual NEV brands. There's too much competition, too much price cutting right now.
Sean, let me ask you about Temu and Shein in Europe and in the U.S. We've seen various efforts come through basically to try to control the flow of some of these small packages coming into both the U.S. and Europe for different reasons. I'm curious how they're navigating the headwinds that they're facing from Europe with the new fees that have been put forward from European policymakers on packages coming into Europe, and the U.S. obviously with the changes to the de minimis rules.
It's not going to be easy for them. I think instead of having a lot of the products shipping directly from China to these other places, they're doing more warehouses in the United States and maybe Europe, and they're trying to do more procurement from other countries. Temu has said to a lot of their factory cooperation partners, instead of producing in China, we want you to move to a Cambodia or a Vietnam. A lot of companies on the small side haven't been able to make that shift. That's why I just said a lot of them have gone out of business in Panyu in the southern part of China. But what you're seeing is the medium and larger factories are starting to shift to other countries, their manufacturing, so they can continue to supply Temu or Shein. But at the end of the day, a lot of companies don't want to move because one minute Trump might slap 46, 49% tariffs on Vietnam or on Cambodia. He might take them down. He's very mercurial right now, which is why I'm very bearish on the American economy, very bearish on the overall global economy, because Scotty Bessent and Trump are really hurting it because companies and investors want to have stable investment plans so that they can predict 3 to 5 years out. That's why I'm bullish on gold, I'm bullish on Bitcoin, I'm bullish on China's equities, because who can trust the United States and the US dollar right now when you have such a mercurial person as president, and Scott Bessent is basically a sycophant and won't push back against Trump's designs.
Sean, you've really sharpened our focus a lot on the China market today. We really appreciate it. Thank you so much for joining us. Sean Ryan with us, founder and managing director at China Market Research Group. And we're just talking about BYD and the back of the discounting that we've seen so far from its pricing, down by 34% in terms of price cuts on about 22 electric and plug-in hybrid models in China until the end of June. And that has been impacting the share price. Now, in terms of the two-day moves, we're looking at a fall roughly of about 10%. So today down another 2.2% in the trading session. A look at how European futures are setting up as we count down to the trading session, about 30 minutes to go. It was a decent bounce yesterday for the boards on the back of the pause on further ratcheting up in tariffs between the EU and US. But the market today looking just a little bit more cautious away from the FTSE that was closed yesterday for bank holiday, set to react and jump to play catch up today.